Hello. Welcome to Exploding Public Debt, Consequences for Fixed Income Markets and the Future of Fiscal Policy. I'm Allison Schrager, and I'm a senior fellow here at the Manhattan Institute. And we are all convened today. I was really motivated to do this because as we're thinking not only about the current stimulus, but on the future of fiscal policy as we come out of the deep recession we're in, we often talk about spending, but don't really think about the impact from financial markets, which is obviously where fixed income prices are set and is really maybe truly our constraint on what we can do. And it seems that there's a real disconnect going on between when we talk about our fiscal priorities and what will happen for financial markets, what it means not only in terms of investment, but how much fiscal policy we can do in the future. So we are incredibly fortunate today that we have three of the best thinkers on this, all of whom not only have deep expertise in macro policy, but also in financial markets. We have John Cochrane, a senior fellow at the Hoover Institution, who's also a research associate at the National Bureau of Economic Research and an adjunct scholar at the Cato Institute. Before joining Hoover, John was a finance professor at the Booth School of Business, and before that in the economics department at University of Chicago. And he also authors the wildly popular Grumpy Economist blog and is the co-host of what is becoming my favorite podcast, which I look forward to every week with H.R. McMaster and Neil Ferguson, called Goodfellas. I highly recommend you check it out. I can't imagine three people anymore you'd want to hear making sense of how crazy the world is. Next, we've got Simon Johnson, the professor at MIT Sloan School of Management. He is also head of the Global Economics and Management Group and chair of the Sloan Fellows MBA Committee. He has been a member of the Private Sector Systemic Risk Council since it was founded in 2012. And from 2007 to 2008, he was the IMF's chief economist and director of its research department. And finally, we've got Rajan, a professor also at Chicago Booth School. He was also the 23rd governor of the Reserve Bank of India between 2013 and 2016, and preceded Simon as the chief economist at the IMF before that. And all of whom as well have just a large number of important publications and work in policy. So, and as I said, all uniquely experts in both macro and finance. So I can't imagine a better group of people to take on these issues. So thank you all for joining us. So to get started, let's talk about the topic of the day, which is the current relief package, which is being hotly debated. It seems the difference is coming down to $1 trillion, which even during a crisis used to sound like a lot. And now we have Democrats and Republicans divided over this last trillion. So I think to kick things off, two questions, which we'll start with Simon, is do we need to spend more than $2 trillion? And if we don't, is that last trillion really worth holding up the stimulus over?
Well, those are great questions, Alison. Obviously, we're in very much uncharted waters. You know, I think that the nature of the shock that's hit the American economy and the global economy is obviously unprecedented. And I would suggest we're actually in a phase of economic life that we've never experienced, which is a sort of survival economics. And the question is, when you think about small businesses, when you think about a lot of the people who've been hard hit and who've struggled to bounce back, obviously the credit markets overall, on average, and for larger borrowers have actually held up surprisingly well, perhaps. But for a lot of smaller firms, they're being crushed. Now, is it really to the good of the overall economy for these restaurants, the small shops, other businesses to go under? What are the frictions that are going to impede the recovery if that's the case? And is there a way to buffer our way through this? It's a very tough set of questions, Alison. I'm on the side of thinking that we should be more generous. I think we should be buffering people more. I really feel that the private sector in this country has taken a beating for no good reason and for no fault of their own. And so I'd like to get as many of those entrepreneurs and their employees through this as we can. But obviously, you can't save everyone in an economic sense.
Could I take maybe a slightly more critical I think we're making a mistake by focusing on how much we spend and not what we spend it on. Simply throwing money out the window doesn't help an economy right now. So I agree with Simon. Let's evaluate our spending as if we had to pay it back, which we will, and that will be costly. So are we spending it wisely? Keeping some small businesses afloat is wise because we'll need those businesses again. They need to reform, but not everyone. There's going to be big shifts. Lots of restaurants will not reopen, and because lots of cities are going to change. So we don't want to keep every business exactly open that was ever there before. And when you start bailing out businesses, you take on not just their current operations, keep their employees hanging around doing nothing. You also bail out all of their creditors. So the case, for example, for bailing out the airlines seems to me much weaker because you're not bailing out the airlines, you're bailing out bondholders. And bondholders who earned a good rate of return on the way up are exactly the sort of people who should be taking a financial hit right now. Airlines can be reorganized in bankruptcy. They are all the time. So let's focus on what's important. I think Simon's right. What's important is buffering shocks to people who have really been hit hard. What's less important is bailing out bondholders of large corporations. And less important still, simply handing money out the window willy-nilly. $1,200 checks to every registered voter play well, but many of those voters like me don't need it.
Allison, I'd like to come in also on this. I mean, I think Simon used the phrase, it's not their fault. And certainly it's nobody's fault. But that's not a good metric, in my view, of how we decide to spend, because in some sense, who's going to be paying for this? It's future generations. And you can hardly accuse them of it being their fault that we're in this mess. So really, I would agree with both Simon and John that it makes sense to spend, but it makes sense to spend as wisely as we can. Clearly, no civilized country wants to see poor people go starving. So some amount of support for those who are poor, who are unemployed, is actually very sensible at this point. But when it comes to corporations, I think certainly airlines need to adjust. You don't want to bail out the airlines, especially their creditors. But many large firms can access financial markets now, don't need help. Many small firms, the tiny ones, yes, it would be great to bail everyone out, but there are limited resources. And the question is, can we start up the restaurant again tomorrow, so long as we have enough credit? And the answer is yes. Yes, the current owner suffers a big hit. That's unfortunate, but that's free enterprise. Now, the real firms that need help because they wouldn't otherwise survive and they'd have to lay off a lot of people are really in the middle. Not so big that they can access the markets, not so small that it doesn't matter if they go bust, at least for everyone except their owner. It's the middle-sized firms, the 100-person, the firms that employ 100 people who can't get credit from their banks, who can't get credit from the markets, who may go bust with a lot of valuable organization and human capital lost. Those are the ones we need to focus on in this round.
And if I could just emphasize, the rhetoric tends to say the government spends as if there's some huge pot of money there that they can just dole out to us. The government transfers. Every cent that is spent to help one person comes from someone else, taxpayers, future taxpayers, bondholders who might be investing in somewhere. All the government can do is transfer resources from one place to another. So that doesn't mean don't do it, but that means do it wisely.
So does this extra $1 trillion, is this worth holding up negotiations over? I mean, is that a meaningful amount of money still?
$1 trillion is a meaningful amount of money. But I think we're losing track in sort of the big headline. I mean, what matters is the details. I haven't read the bills of exactly where this money is going. I hope Raghu and Simon have done so more, but I really think that's the issue. And I think we should get around the political sideshow of one party versus another on this question.
Well, some extension of unemployment insurance is certainly warranted. How generous it should be, what the top-up should be over that, I think one can debate. But in general, the United States has relatively thin unemployment insurance relative to other industrial countries. And if unemployment is really high and the jobs aren't coming back till we find a vaccine and it is widely distributed, it makes sense, at least in areas that are strongly hit, to prolong the unemployment insurance for some time. That's money.
Let me just put a note in there. What we are good at is economics, and there's this problem of help. You want to help people who need help. But the problem with helping unemployment too strongly is then people don't have the incentive to go get a job. So obviously unemployment insurance, much as I'd like to give everybody something, unemployment, even leaving aside where it has to come from in terms of taxpayers, if you pay people to stay at home, then they stay at home and they don't go back to work. They don't move if necessary. And right now there is not just a lot of unemployment, but there's a lot of businesses who can't get people to take jobs. Because when unemployment was even more generous than going back to your job, obviously people didn't want to go back. So it's just not an easy question of give more help versus not. There's this, all unemployment has to do this fine balance of the incentives versus the help. And Europe, supposedly socialist Europe, is in many cases much more hard-hearted than we are. They give more money, but they're much more hard-hearted about when your employer calls you back up, you must take the job or you lose it. So they control these incentives in a way that's much harsher than the United States does, even though they offer apparently more money.
Allison, this is a great discussion, and I really commend the Manhattan Institute for putting this issue out here, and of course Raghu and John are two of my most brilliant colleagues. But I'd like to ask a question, which is, if the United States were hit by a meteor, a large meteor, but not the kind of meteor that ends civilization, but let's say the meteor killed 200,000 people. And let's say further that it damaged consumer confidence in such a way that people were afraid to go out of their houses. They were afraid to have in-person transactions because of something that happened to the atmosphere, perhaps. Would we be having the same discussion about we should really spend a little bit less over here or a little bit less over there? Or would we be saying, look, we have to get the economy back on its feet. We're in a massive stall right now. We are losing future output, I would suggest, because we're not making necessary investments. Raghu was right that in the private sector, we should be very careful. We should differentiate. There's a set of firms that are actually doing quite well. They have access to credit, that they're run by people who've regained their confidence, and they are making investments. So that's the good news. The problem is that a lot of people I meet in the smaller business sector are absolutely terrified. They don't know where this is going. The uncertainty, even around the medical testing space, where I do a lot of work with people right now, is enormous. And as a result, people just hold back. And I would say we're losing output today, and we're losing output in the future. We're going to have a smaller economy if we continue with the current policies and the current reluctance to really push hard in terms of restarting the economy.
I think in terms of when you bring up consumer confidence, there's this idea of stimulus to stimulate aggregate demand, which is sort of our all-purpose economic. When you're a little tired, you need a cappuccino, let's have some stimulus. But when you have a virus, cappuccino doesn't do any good. And you can give people all the money you want to stimulate aggregate demand. They're not going out to restaurants and they're not going on airlines. Half of that is because the government has closed down the restaurants and the airlines. The other half of that is because people are scared to death and they don't want to go in restaurants and airlines. So a lot of what is shut down now is not solvable by lots more aggregate demand. Places where you can buy, house prices are going up, cars are selling well. It's hard to say that this is a Keynesian recession.
Yeah, absolutely. No, John, I never said that.
No,
I think it's survival economics, a really bizarre wartime. Yeah. I mean, it's not World War II, right? World War II in the US was very different. It's not the Great Depression either. That was also very different. It's extremely strange. There's a large number of people who need to survive this phase. We want this phase to be as short as possible. On your $1 trillion, Allison, the question I would ask is, why aren't we spending a lot more on everything to do with testing?
Yes.
Individuals, schools. I mean, it's incredible, the underspend, because this is not about inventing new technology or about waiting for a vaccine to be adopted or proved safe or whatever. We have the technology. We need to scale it up. The private sector is doing actually a remarkable job. It's the public sector that's really holding us back. And I'm speaking at the local, state, and federal level to an extraordinary degree. I don't need $1 trillion for testing, to be clear, Allison, okay? But there is, I think this also fits with what John was saying earlier. It's what you spend it on. We have lost sight of, or maybe we never had in this phase, a strategy for how we get the economy back on its feet. And then, of course, we have to talk about fair, responsible debt
I
payment.
didn't want to accuse you of Keynesian, but lots of people are in this debate and view this when they say we need more stimulus. The word stimulus means, not we need to spend on things that will help get us over this thing. The word stimulus means Keynesian stimulus.
My word is survival.
$100 billion would pay for tests for everybody every day. And it's criminal that not only are we not spending that money, the FDA is not allowing us to have tests. That we could end this thing in a month if the FDA would allow us to have daily testing. Then we can fight about who has to pay for it. But the amount is tiny. We spent $5 trillion on this business, and we're not even beginning to pay for the testing. So, and your comment also, you said that there would be uncertainty. Where is the uncertainty coming from? A lot of the uncertainty is coming from policy. What are what the restaurateurs are scared about is not the virus. The restaurateurs are scared about that their local government's going to shut them down for another 3 months and then they'll be out of business. So there's a lot of policy we could do to remove uncertainty. Right, you're desperately to get a word in there.
They're also a little worried about demand, right? You can't run the restaurant at 10% of capacity. So I think we're talking about three different things here.
But the demand doesn't come from lack of money. It comes from virus.
I understand. I think we're talking about three different things. One is the regular Keynesian stimulus, which is your point, John, about giving people more money to spend. And right now, that's not that shouldn't be the focus. Then there are two other things. One is making people more confident to go out, which is, dealing with the medical issues. That would be helpful for demand. And that would require more spending on medical assets and so on, testing, et cetera, et cetera. And the other that Simon has been talking about is two forms of relief. One is for poor people, the unemployed, just to help them, consume, which is a good thing. It's not about demand. It's just to keep them alive. That's important. And the second is to keep firms alive. That's about the supply side, making sure that the economy's body, in some sense, doesn't atrophy while the virus is on. And that is really not Keynesian spending, but it's just making sure that these entities survive. And there we should probably pick and choose which ones really need help and are worth the dollars that we're putting in.
But their creditors should take haircuts where at all feasible. And actually, let me say a word in favor of spending. The CDC decided in its infinite wisdom that no one had to pay their rent for another 6 months. That's ridiculous for a health agency to pass, and that's a transfer from renters to landlords. If we want nobody to pay for rent for every 6 months, that should be on budget, paid for by the U.S. Treasury, not out of small landlords. So there's a good case for spending as opposed to what our government often does, which is mandate that A transfers to B.
I said, keep things going, because we could probably, it's tricky when you have both a supply and a demand shock. I think that's one thing we can take away. Oh, also, I forgot to mention, I encourage everyone in the audience to put in questions as we go. So feel free to join in. But you all said something which I've always believed it has become actually quite controversial on economics Twitter now, which is you said we have to pay this debt back someday. And I think I was there when Olivier Blanchard made that address to the American Economic Association, where he said maybe we shouldn't worry about debt because as long as we're growing faster than our interest rate payments are growing, then we can just run debt forever. I do recall in his speech there was like a very brief aside that if growth lowers or interest rates increase, that maybe this won't work and that would be really bad and it could get really bad really fast. So let's unpack that a bit. If we do continue to spend, not only in the short term, but if we have a President Biden, he's planning on spending $11 trillion over the next 10 years. What would make that happen? I mean, are we like, why? Well, first of all, like, why have interest rates been so low despite the fact that we've had so much debt?
Can I take that one on? Because I've been thinking about this lately, and I've also had a wonderful correspondence with Olivier and with Larry Summers on this issue. As usual, the quest, we're thinking about the wrong question here. So whether the interest rate is higher or lower than the growth rate of the economy, that question is about, can you take a steady debt to GDP ratio, like 100 or 200%, and do you have to run very small perpetual primary surpluses or very small primary deficits and keep that debt to GDP ratio stationary? That's not the issue at hand. The issue at hand is, what if we're running $1 trillion deficits during good times and $5 trillion deficits during bad times, and the debt to GDP ratio is exploding? And Blanchard, if you read his paper, he's very clear about it. There's an upper limit on the debt to GDP ratio somewhere out there. Nobody knows quite where it is. There's a moment when bond markets say, you guys are never going to pay with this, pay it back, we're done. And that's the danger. It's not really so much a slow, our children and grandchildren have to pay stuff back, because that's hard to get people excited about. And it's also not really the issue. The issue is, if you're doubling the debt to GDP ratio every 10 years, sooner or later you come to the point of a debt crisis, and that's kind of where you are heading, and that's really the problem. And that has nothing to do with R greater than G or less than G or all these things we like to talk about. And now, why bond markets don't see that? Interest rates are low, and the reason is because that kind of a crisis is like a run. Debt crises are like the Spanish Inquisition. No one expects them to come. If you knew they were coming, they would have already happened. Interest rates, in fact, have never forecast. They didn't forecast inflation in the 1970s, and they didn't forecast the disinflation in the 1980s. So interest rates didn't forecast the Greek debt crisis. Interest rates didn't forecast the Lehman was going to go under. These things have a run-like mechanic. So the danger is, we're in this loop where we're having big deficits in good times and huge deficits in bad times. Washington is spending as if no one ever has to pay it back. We are now bailing out more and more private debts, adding to this debt. The moment will come when the combination of very large debt and the markets lose their faith that we'll be able to pay it off in the future. Perhaps they'll see some sort of haircut coming. And then there's a debt market, and we can go into what that looks like. It's just an utter bloody disaster.
Well, we know what that
on is the danger.
We know what that looks like, John. Just look at some of the emerging markets. Brazil. Brazil has just spent close to 15% of GDP on the crisis. I think that was good spending. But Brazil is a country which has far less room to spend than industrial countries. And now the big concern in Brazil is, what do the politics look like going forward? Are they going to be able to cap their deficits going forward so that the debt has some chance of being sustainable? This is John's point, that in industrial countries, the markets are willing to give you more room because they think the politics are much better, that eventually you'll get the deficits down. There will be some agreement on cutting spending, on raising taxes. And, this is the way industrial countries have behaved. They've got credibility for this. The problem, of course, is the politics in industrial countries are also changing. Just look at the previous presidential debate. And given that, the belief that, in fact, we will get sensible fiscal policy going forward is perhaps a little more uncertain or likely to change than it was in the past. And I keep saying the difference between an emerging market and an industrial country is simply the quality of the politics. And when the politics in the industrial countries deteriorate, your debt sustainability becomes a lot more like emerging markets.
So following up on your expertise in emerging markets, I mean, how much of the reason why we've had such low interest rate has been emerging markets buying our debt? And do you think that's going to keep happening?
Well, I think emerging markets have been buying debt over time of the industrial countries, but there's been also a reverse flow. And the question is, which causes which? Is it capital flows into the emerging markets, which is causing their central banks to send it out again by increasing their reserves? Or is it the emerging markets increasing their reserves and thereby pushing capital into industrial countries, and that causes a reverse capital flow? It's hard to say which causes which. The point, however, is if you have a lot of capital inflows as an emerging market, you're very worried because you don't pick the timing of when it comes in and when it goes out. It usually comes in when everybody's pouring in, and it goes out when the Fed tightens interest rates. And the Fed tightens interest rates when the US economy is hotting up, not when you have surplus capital and are willing to see the money go out. So as an emerging market, you really have no control over the flows. And you saw that in March this year, before the Fed came out with this blanket set of policies which assuaged markets, you saw money going out of emerging markets in a big way. Now, when that happens, what the emerging market central banks have, in some sense, to buffer that shock. Otherwise, they'll have a lot of bankruptcies, just like we're worried here. And so what they do is they tend to support the currency at that point. And that's why they build up reserves. That's one reason why they build up reserves. And so, we're stuck in a unfortunate set of events. Capital flows, reserve buildup, push me, pull you of capital. Nobody wants this excess capital. And that's a strange phenomenon in a world where we're building up huge debts, etc. But it is capital flowing around the world, which you don't control.
Allison, can I go back to what John said a few moments ago and link that also to Raghu's point? I think the if we think about when did our politics go off the rails with regard to thinking about fiscal policy, surely the problem has become primarily that in the booms, in the good times, we're no longer as careful as we used to be. If you look at 200 years, 250 years of American fiscal history, we ran up debt, we had ran deficits and increased our debt in times of crisis. We may disagree or disagree about whether that was an appropriate thing for that particular crisis, but that's what we did. And then in the good times, subsequently, we grew and interest rates were lower. Perhaps they were held down artificially in some episodes. And we certainly were more careful on the fiscal side. I think what's characterized the latest cycle and what's really worrying is a number of people who say that deficits and debt don't matter in the good times, and therefore when the bad times happen, when a meteor strikes or whatever the next shock is, you're not ready for that. And I think that Raghu's right, as always, that the quality of the politics is the key thing, and that's very much about, are you careful when you can be careful in order to create space when you need it? And we are very lucky in this country, remarkably lucky, that people still regard the US dollar as an attractive asset and US government debt as a relative safe haven. And if the world is very uncertain and dangerous, you want to have more of the safe assets frequently. But I agree with John, this will not necessarily carry us forever. So in the good times, you have to be more careful.
Well, we have a question from the audience of when do you think that breaking point is?
So I've been trying to make people pay attention. I've been trying to do my fiction writing talents, and let's try and put together the scenario. When does the U.S. have a debt crisis? Imagine we have several years of very bad growth, bad productivity growth. We have another severe recession. We have maybe another pandemic, maybe a war. Bad things can happen all over. The U.S. has been running more deficits, so we're at 200% of GDP. All of a sudden, the U.S. wants to bail everybody out again, so we need another $5-10 trillion. The U.S. has chosen to borrow very short term, so at the same time, we need to roll over our money. This is a key part of the crisis dynamics. If we would only borrow our money very long term, like a household that takes the 30-year mortgage rather than the adjustable rate, then we're much more insulated against problems. But no, so let's add to our trillions. We need to roll over 10 or $20 trillion worth of debt. And let's add political chaos, which I think Raghu exactly, rather than a sober country that's saying, here's our long run problem. Here's, let's suppose we're having an impeachment, an investigation. We're in the middle of another recession, another election where lawyers are fanning around the country. There's riots in the streets, if you will. This is the kind of moment at which bond investors say, I'd just rather have those Swiss francs right now. I'm not going to roll over the U.S. debt. Then interest rates spike, and then what had previously been affordable becomes not affordable. And it's not just like an emerging markets crisis, because the U.S. is the world's firehouse. It's not your house burned down, it's the firehouse burned down. We count in the U.S. on our government flooding everything with money every time things go wrong, bailing out all the financial instruments, bailing out all the companies that have taken on too much debt, supporting everything. Imagine the calamity when the U.S. government is in trouble. And imagine still, we talk about we can always inflate rather than default. That's not obvious. Let's put it this way. In a time of fiscal real urgency, will our legislators say the most important thing is to bail out the Wall Street fat cats and the foreigners who own our debt rather than poor Americans? The chance of us saying there's a haircut on debt is not insubstantial, and that leads to the crisis even more. That leads to financial calamity. The whole financial system is based on the idea the U.S. dollar will never default. These are unlikely events, but a financial crisis in 2008 was an unlikely event. A pandemic that got out of control was an unlikely event. Unless you think about the unlikely events, you'll find one happening.
So we have a bunch of really good questions coming in. And one is sort of on that, what you were talking about is the U.S. has had a lot of space to run up debts because it's seen as the reserve currency. Are we in danger of losing that? And if so, where are people going to go?
Well, in the short run, I don't think there's a huge concern. Partly because what are the alternatives? The euro, which unfortunately, euro area policy is not cohesive. Till recently, they didn't have fiscal policy across the euro area. Now they've started doing it. The euro may look a little more attractive, and the renminbi. And of course, there are large concerns about your ability to get in and out of the Chinese market. So the US still stands out as a place where you're willing to let your money ride, and the markets are accessible, it's liquid, and it's still, modulo what John said, fiscally very sound from the perception of the rest of the world. But we are changing the facts on the ground. For example, if you start limiting access to the payment system,
yes.
If you start levying sanctions here, there, and everywhere, people start worrying about using the dollar. Maybe, I get sanctioned. Maybe they prevent me from taking out my dollar assets. And the more the financial system is used as a weapon, the less the US becomes attractive as a place to store your money in. And so this is a concern that, already Russia is wary about using. You may say we can do without Russia, but what if China starts saying we don't really want to use the US systems of payment, we don't want to use SWIFT, we don't want to park our assets in the United States because there's always a risk that they might be expropriated. A lot of people are relying on the rule of law in the US and that it will not be used for political purposes. If that changes, I think there is a lot more chance that the U.S. may be less attractive as a reserve currency.
Okay, go ahead, Simon, then I'll jump in.
Thank you very much, John. So I would say, Allison, that we should prepare for the day when the international financial flows and portfolios shift away from the US dollar, just as Raghu was saying. It has gone on for a remarkably long period of time. It will not go on forever. And I think that's entirely reasonable. But back to what point John made about the financial risks and what could bring the house of cards down. By the way, John, I think you described Russia in 1998 really vividly in your historical example. So, great empire becomes Russian precarious finance and the crisis in 1998. So it happened somewhere. But the really scary thing, I would say, Allison, is the politicians, including leading senators who not so many years ago advocated that the US should default on its debt. That was an extraordinary moment. To me, that was a different political moment, sure. It was different fiscal dynamics, but that was a scary thing. If you have people who get elected who are in charge who think it'll be okay to reduce the value of US government debt for whatever reason, or to stop making payments for whatever reason, that is the what we're going to be calling the Cochrane scenario.
Let me add on both of these, and cheering both, especially Raghu's worry about our overuse of sanctions, which I think is that just leads people to, we can sanction, but then they're going to find something else other than the dollar. There's a big puzzle right now. Why do people want to hold so many dollars? The need to hold a lot of the reserve currency is vanishing technologically. You can hold your money in German stocks, if you will, and if you're a large institution, if you need to make payments in dollars, you can change those stocks into dollars in about 20 milliseconds, and your recipient can change the dollars back into stocks in about 20 milliseconds. So the need to hold a large quantity of supposedly risk-free assets doesn't exist anymore technologically. Now, people still have it, but that desire for risk-free assets can go to a lot of places. As in the 1970s, when people started to doubt sovereign debt, they went to real estate, stocks, bonds, commodities. There's lots of other places to put your money that is insulated. It may not be nominally risk-free at a short horizon, but it's insulated from your worries of a world that's falling apart politically and may inflate or default. And just as a last, I like Simon's allusion to hundreds of years of history. We have to remember that for, I'll put it at 800 years, I think, since Edward III defaulted on the Peruzzi Bank, Sovereign debt has not been, by and large, the risk-free asset. Sovereign debt is one of the riskiest assets around because there's no collateral and they can always default. We've lived in this very strange time when unbacked money and sovereign debt has been seen as the completely riskless asset, and a strange time that people wanted to hold a lot of that, even though technologically they didn't have to. Those things can change, and like all tipping points, they change all of a sudden when you least expect it.
But that's a great point, because I never really thought about it, because it's only been in my lifetime that a fiat currency could be the risk-free asset. But I guess that was pretty wild to people years ago. So why not German stocks? So we have a great question from Mickey Levy. In 2020, the federal budget deficit was estimated to be $3 trillion. The Fed is poised to absorb 60 to 70% of the CBO estimates of new debt in 2021 to 2023. Please discuss the dynamics of these flows and what are the political implications.
Well, I'll jump in because the other two didn't do it quickly enough. We need to think of, so the Fed reserves are interest-paying government debt. They're overnight interest-paying government debt. So there's really, the idea that we're printing up money which will hyperinflate is wrong, as long as reserves continue to pay interest. There is some difference. The Fed jumped in and started buying up treasuries because the treasury markets weren't absorbing new debt. They saw problems. I think we're starting to see the first hiccups of resistance. And there's two other differences between the Fed's issuance of overnight government debt is held by banks in terms of reserves and therefore indirectly by you and me in terms of deposits. And bank deposits have gone up like crazy. Now, apparently, investors aren't that interested in holding actual treasury bonds and bills, which is why we've gone to this direction. How long are they going to want to hold trillions of extra dollars of bank reserves that are funneled into overnight debt? Problem one. And problem two, that action shortens the maturity structure of government debt outstanding. So it means we've gone in the opposite direction. If interest rates go up, the interest rates on overnight debt go up overnight. So right away, we're faced with higher interest costs. Whereas if we had funded this thing by very, very long-term debt, if interest rates went up, the US government really doesn't care fiscally until it has to, for 30 years.
Yeah, just on this, I mean, I think John makes a very good point when he says, don't think of the financing of the central bank by its issuing reserves, which people colloquially call money printing, as different from the government financing itself. And there's, the whole of this modern monetary theory is based on these being very different. In fact, what we should be looking at is the combined balance sheet of the government and the central bank. That's all that matters, because money is a government obligation, much as government debt is. And if you think about it that way, the point that John made, I want to emphasize it, which is, what is the worst way to finance long-term spending today? It is to issue money to finance it, because what you're doing is issuing very short-term debt to finance that. If you could, you should issue long-term government debt, because then you're locking in the low interest rate to finance your government spending at this point, rather than making yourself susceptible to any spike in interest rates as you go further. So don't finance through money, finance through bonds if you can. The only reason to finance via the central bank is if the markets find it difficult to absorb in the very short run because of liquidity pressures, etc. But it does mean that as soon as the central bank gets the chance, it should unwind that by pushing off those bonds into the market.
Central banks could also, our Fed could do term financing. They can do fixed rate long-term stuff as well as short-term stuff if they wanted to. We can issue our treasury. Every two-bit bank in the country knows how to do swaps. So our treasury could issue fixed for floating swaps and stop the interest rate crisis, the interest rate problem. So I agree entirely. And I want to invoke the spirit of your frequent co-author, Doug Diamond, who says that financial crises are always and everywhere the result of short-term debt. And that we should just put that up on the Treasury building as a daily reminder to them.
Do you think there's an appetite for 50-year bonds?
Yeah, what a 30-year bond, like 1%. I want perpetual bonds that have, Queen Victoria issued them at 1%, bonds that pay just coupons and no principal ever. That would be a great innovation.
Yeah, well, I'm a pension economist, so I'm always about everyone's short duration. So I've always been about long duration bonds and think everyone's short, especially in the UK where they're required to hold long-term government bonds.
Yeah, long-term debt makes a lot of sense. I mean, if are you planning to die? Unless you're planning to die in a week, you don't want 1 week debt. You want long-term debt.
Is it possible? Do you think we have the ability, even if we wanted to inflate away debt, could we? It seems like the Fed doesn't have a lot of control over inflation anyhow.
The inflation will come not from actions of the Fed, but from the private sector. When people decide they don't want to hold U.S. government bonds, what do? Go out and spend. There's the inflation. It's a fiscally led inflation is not one that the Fed can do much about one way or the other. As you know, ask the Central Bank of Argentina, or the Central Bank of Venezuela, where I guess Brazil too. What can they do about inflation? You know, when people say we don't want the government debt, we don't want short maturity government debt, we don't want long maturity government debt, there's just not a whole lot you can do about it.
Well, you know, that's John talking about the fiscal
my book,
price, which I think makes sense. But there are other reasons. Even if you think that central bank credibility is the central thing keeping inflation from going up, it's not about government debt, it's about central bank credibility. Even there, you have to worry a little bit, because all the actions recently have been towards being more accommodative of inflation, because central banks feel they're fighting the problem of disinflation. So they want to be much more accommodative. As Paul Krugman once famously said, they have to essentially commit to being irresponsible, commit to allowing higher inflation. The problem, of course, is that if you are too successful there, you've got the reverse problem, very high inflation. So take, for example, recent Fed actions. We're going to worry about inflation over the cycle. That means they're going to run inflation a little hotter. But not just that, when they talk about what they define as maximum employment, they're also saying this means it has to be an inclusive employment. Now, when are minorities hired? Typically at the fag end of the cycle, when you've run through, unfortunately, this is a feature of the labor market, when you've run through the normal majority hiring, you then start hiring minorities. Well, what that means is if the Fed is serious about this, it is going to wait for longer before it starts raising interest rates, even modulo the averaging over the cycle. So, I mean, I do believe this is in response to what you said earlier. Central banks have been singularly unsuccessful since the global financial crisis in raising inflation rates. But now there's a danger with the huge amount of debt that's piling up that the problem may actually be the reverse one in a couple of years of holding inflation down. And if they actually sort of get away from their constraints, they may actually be contributing to the problem 2 years from now.
Let me just chime in before Simon comes, because I was a little too doctrinaire there, and I want to back off that a little bit. I think Raghu was exactly right. You know, the danger is a little bit of the 1970s when we were late to the game. It's like being, if you were an alcoholic, just taking one drink, and that would really cheer you up at night. A little bit of inflation is hard to achieve. And really, objectively, guys, 1.6 instead of 2 inflation and unemployment that was down in the 4% before February. I mean, maybe the Fed just needed a mission accomplished flag and add a standard and say it's between 1 and 2, and they would have been happy. The danger does lie in the Fed. Suppose we have one of these fiscal problems. It manifests itself as sort of a run on the dollar. The dollar's plunging. The interest rates in bond markets are going up. And now what central banks have to do is defend the currency, which means sharply raise interest rates, even though that's going to cause a recession. So, is the Fed going to be willing to do what it did in 1980, 1982? This is the conventional reading of history, and inflation expectations are anchored because everybody thinks that the Fed is going to be tough. And if that event happens, they're going to really jack up rates. Dude, let's not forget, we were in the, 15, 20% interest rates back then in order to contain inflation. Well, is the Fed really going to do that? I think Raghu's right. They just took one drink.
Well, you also wonder, someone my age or younger has no memory of inflation. I don't think they have any, when I talk to other, especially financial journalists, they have no concept of why inflation's even bad.
Well, you should read a history book or travel a little bit.
So
I have no memory of the Great Depression, but as an economist, that sticks big in my mind about events that can happen.
Yeah, but you wonder if it undermines, the Fed's ability to sort of increase rates. People don't understand why they would. I mean, I'm shocked that so many people just genuinely don't see any downside to expansionary Fed policy now. They think it's effectively a free lunch.
Well, to defend the Fed, I think the way to interpret all of the smoke coming out of the Fed right now is that they were a little bit burned because they started raising rates when they saw labor markets improve. And in retrospect, they thought that was too early. So what they're going to do now is wait till they see the whites in the eyes of the inflation. They're really on now an inflation target. Now, an inflation target is a good and fine thing. And so the only question is if inflation does get to 2.5%, do they start raising interest rates in response fast enough, or do they find excuses, impaired markets, it's still too slow, other reasons to, as they did in the 1970s, not to start beating down the inflation?
Almost surely, the experience of the last few years will make central banks react a little too late the next time around to inflation, because they've been fighting this war to push inflation up, haven't succeeded. And they're going to be much lower and bring it back under control the next time around because they feel that they have the room. They want to make sure that, as John said, who was it? William Chesney Martin, who said, by the time you see inflation in the eyeballs, it's too late. He said all the good things that the Fed sort of chairman have said. But nevertheless, it may well be that the next time around, it's harder to control inflation. But many central banks today will want that, and in some sense, that's part of the problem. That they feel a mild inflation will bring the debt levels in better sync with economic activity, and so I think they're going to be more open to higher inflation, which in fact will make it more likely.
I have a question for Simon. So we've been discussing a lot how, we really have to take that seriously, particularly as we come out of this recession. But let's assume that, pandemic ends and we have a very sort of slow but positive recovery, similar to what we had after the financial crisis. The Biden administration plans to do a lot of spending, even beyond pandemic spending, a lot of some elements of the Green New Deal, certainly a lot of infrastructure spending. I mean, is this, one, desirable, and two, do we have the ability to do that?
Well, I think I would go back to, I think it was the first remark John made when we started this session, Allison, which is it depends what you're spending it on. I think we need to boost growth. We need to boost productivity growth. We know that key elements of that are purely private sector action, but there's some other elements, including some parts of education, including research and development, including some infrastructure, for example, that need to be arguably are better done through the public sector. And so I think I would ask that question always, Allison. Are we boosting growth? Are we increasing productivity? And I do think, by the way, that the question of who shares in that productivity growth, what kind of jobs are we creating? Are they spread around the country, for example? For various reasons, over the past 20 to 30 years, growth became extremely concentrated on the East Coast and the West Coast and a few other places. And that's obviously generated a lot of friction. And it's not clear that that's a particularly good way to allocate resources or to drive growth. So I think if we're talking about, for example, investing more in research and development, pushing up science spending and spreading it around the country, creating more scientific hubs and focusing on commercialization. So you're creating more private companies coming out of that scientific, innovative commercialization. I think there's room for a lot of that.
But I would say, so the science budget is like 0.0001% of federal spending right now. Basic science is not really the issue as far as money is concerned. Productivity growth really has not come out of massive federal spending. And things like the Green New Deal is designed to lower growth. We're going to spend money to do it in less carbon ways, maybe, but certainly not a growth agenda. So I think the forecast is for lots of spending on all sorts of things, most of which is about a social agenda, not really about focus on economic growth. Comes from deregulation, brutal competition, private sector innovation, which is what raises productivity. And the idea that you throw government money at it to raise productivity, I think doesn't bear out. But I would forecast lots of it. And for a simple reason, we have all this fancy stuff about transversality conditions and R&G and debt crises and repayment and so forth. You're a politician. You're in Washington. The bond markets are offering you money at 1% when at negative half to negative 1% real rates of interest. You're like a household in 2006 that's getting credit card companies and offers to refinance your mortgage. And there's some vague thing about my grandchildren might face some taxes someday. That is just not salient compared to money being thrown at you. And I notice in the rhetoric in Washington, there used to be we're going to borrow money to spend it. And yes, our children have to pay it back, but this is worthwhile. Now that rhetoric is just entirely gone. This is free money. Why is it free money? Well, if you went down to the grocery store and they were giving you tomatoes for 1 cent each, you'd say, well, let's buy some tomatoes. And I think it's going to keep going until the bond markets say no.
Well, finally, I found something to disagree with John on. I think we've been agreeing far too much today, John, actually. So federal government spending on R&D is between 0.6 and 0.7% of GDP. It used to be close to 2% in the 1960s. A large number of industries that were created coming out of World War II did have an important public dimension, an investment dimension. Yes, there was procurement, there was the Department of Defense, there was the computer industry, there was Silicon Valley, John, where you live now. This spread across pharmaceuticals, this spread across the Human Genome Project. We actually did this really well for about 40 years. And I would say, by the way, it was done in a fiscally sensible way. So Eisenhower was absolutely on board with this agenda. And after Sputnik was launched in 1957, the American response was to invest more in science and in education for science and to make it easier for more smart people to go to school, because that's what they figured the Russians were doing. And they looked at how many engineers we were producing versus how many engineers the Russians were producing, and they said, we have to do better. And they did. It was a remarkable success. And it wasn't about blowing massive holes in the budget or anything like that. It was about being careful, and it was about investing, and it was about thinking, I would say, John, about the public-private partnership, which has been an enormous strength of this country. And I'm totally on board with not blowing up the fiscal, the budget. The problem with the budget, let's be quite honest, guys. The problem with the budget is, over the past 30 years, some people who travel under the heading of fiscal conservative, quotation marks, were not actually that fiscally conservative. They didn't really care about debt and deficits at all. It was Cheney who said debt doesn't matter. They went for broke. They cut taxes. They ran mass deficits in the good times. That leaves you no buffer, Allison, when the meteor hits. This is a goddamn meteor. We've been hit by the largest shock in the history of modern humankind. It has killed 200,000 people, and we have done too little as a nation on the health side and on the economic side. And we are struggling to come back, and the consequences are going to be awful for millions of people. And I am with John and Raghu on the need for fiscal responsibility and the fact that we're lucky in this country and we're not going to be lucky forever. But if you blow it all in the good times, guys, you're going to have really bad trouble when the meteor hits next time. Let
me agree and just make sure you can take that 2% of GDP that we spend on federal R&D and triple it, as far as I'm concerned. Because it's still a tiny fraction of the federal budget. That's not the spending. The spending problem in our federal budget is that our government basically serves to write checks to people. And so the problem is healthcare. The problem is pensions. The problem, I'm completely with you on R&D. Now, there is problems on how the NSF, you look at studies on how the NSF now rewards contracts, and it's not as efficient as it was back. Having to fight a Cold War and really needing results out of it was pretty handy for the federal science. So how we spend on science needs reform. And you guys, we all work in academic institutions. There's politics going on that are not just about the highest quality and the best result in academic institutions. So throwing money at us, I don't want us to be on tape saying, throw money at us, dear federal government. We also need reform in how we spend federal money for R&D, for basic science, and in the universities.
Yeah, just to make sure we're not leaving the emerging markets out. To Simon's point that, what happens when you can't spend? You get the situation in many emerging markets today. They simply do not have the money to spend on relief. They do not have the money to spend on repairing their firms. And as a result, what you're going to see is many lost years of growth. We're talking about, do we get back to the pre-pandemic levels by the end of 2021 or the middle of 2022? There are a number of emerging markets, Mexico, Peru, which are talking about India, which are talking about whether we get back, in the next 5 years, because the damage that's done to the economy without the ability to spend in terms of relief, it can be really quite significant.
Can I also, I think Simon was a little too extreme on this was the meteor and 200,000 people died. In World War II, 80 million people died. In the flu pandemic of 1918, far more died. This pandemic, actually, I view as our fire drill. It was just enough to get our attention. But if you compare it to the bubonic plague, typhus, cholera, the influenza of 1918, there is a much worse one out there. We were caught completely flat-footed. Our public health response was completely incoherent. Unfortunately, the move to reform that, I don't hear anybody saying, rather just defend whatever we did. But we just got the wake-up call as far as what pandemics can do, and as far as human misery can do. I'm sorry for the 200,000 who died, but I'm also sorry for the 80 million who died in World War II. I mean, horrible things can happen out there.
John, give it time. Sorry, Simon, just one second. Give it time. I think there will be a response across the globe when we, get past this. How do we prevent a recurrence? How do we deal with such issues once again? And to your point, I mean, the extent of global cooperation on this issue was abysmal. And we will recognize that. And I think we will have to go back to the drawing board. What kinds of global institutions do we need to monitor the presence of such viruses, and then to bring together a global effort? Where do we keep medical equipment reserves? Should every country have the same, or should we have some way of sharing the reserves so that the countries that are first hit get the reserves, and in the meantime, everybody starts manufacturing like mad? I mean, those are all issues we should debate now that this has become a serious problem.
Global, national, state, local. I mean, the failure was absolutely everywhere. And, as after 9/11, there was a sort of hey, this cops need to be able to talk to the firefighters kind of reform. We need not only to there were about 12 pandemic plans. Nobody even bothered to look at any of them because they didn't know they were there. Nobody practiced them. So yes, you need a bureaucratic reform so that, now, of course, the next one won't be just like the last one, but we need to have a public health response to the next pandemic. And I think this pandemic was actually quite fortunate, because it's just enough to wake us up before the next one comes, which could kill. I mean, imagine one like this, but kills 10% or 20% of the people. That's in the biology, or it's in the bioterrorism. So we really, that's the number one thing that needs to be done. And I hope you are right about the will to reform international institutions and then keep it going. California put together mobile hospitals and spent a lot of money on them after H1N1. And then Jerry Brown decided to not spend the $5 million to keep them going because he wanted to spend it on the high-speed train. And then we didn't have them when we needed them. You need the 10 years of quiet that you keep these things going and don't let them develop other agendas, which is what all of our institutions did, and get politicized, which is what all of our institutions did. You need regular fire drills, and I hope we are capable of that institutional reform.
So just quickly, because John, I think the audience has to go at 5, even though you and I can stay on for 3 more hours. But just very, very quickly, John, look, you're both obviously right that we need a better pandemic preparedness. I spend most of my time working with private sector people who are trying to stand up a response to this pandemic and build something that's going to be lasting. And we are dragging behind us, kicking and screaming, the local, state, and federal public health officials. Okay, that is remarkable. But I have to say to you that ultimately, we will need some public investments of some kind, because there are some things the private sector will do a lot, and I think that's appropriate. I'm all in favor of that, and we'll do some of it for pay, and we'll do a lot of it for free. But then we're going to need the government. And just finally, it's remarkable, Allison, really, really interesting, but maybe speaks to the times, that we have not mentioned the number one driver of fiscal deficits and projected debt in the United States over the next 40 years, which of course is healthcare spending. And I hope we can get back together and have another discussion, because this is such a productive group. But I do think that the fact we spend 18 or going on 19% of GDP in the old days before the pandemic on healthcare in the United States, we don't get much better outcomes than countries that spend 8 or 9 or 10% of GDP. And to John's point, we definitely didn't prepare for the pandemic. And when the pandemic hit, it all went pear-shaped. Those are really important points. And let's get back together and think about fiscally responsible ways to bring healthcare costs under control, to bring better healthcare to everyone. I'm sure we'll be supporting that, and to build the resilience into the system, both early warning, rapid response, and then, oh my goodness, it's upon us. How do we adapt to that? I don't think we should spend more, John, to be clear. I think we should spend less, maybe even dramatically less over the next 40 years, but we've got to spend it differently. And that goes back to John's original point. What do you spend it on and how you spend it is always going to be the key question.
But the pandemic response, here I want to disagree. We can spend a lot more on pandemic response. $100 billion on pandemic response is nothing in the $5 trillion.
We already agreed on that one, John. That one should check that box.
I just didn't want you to shortchange pandemic response. Yeah,
absolutely. Testing, right? Can we have a final shout out for testing and spending more on testing? Because that's what is going to get people's lives back and their money back.
Just allow it. I've got the money. Let me go down to CVS and take the 5-minute $5 test. The FDA won't allow me.
We need to talk about that test, John, by the way, afterwards about specificity and sensitivity. I have some better tests for you to consider, okay? The good news is they do only cost $5. So that's the private sector innovation that we need. That's the competition that's now coming through, right? And the FDA has, without question, not been super helpful.
And that has been remarkable that we have tests 6 months into a pandemic. Yeah. We're talking about a vaccine 8 months into a pandemic is just unbelievable. I mean, that's just a miracle, thanks to science, both federally supported and private. That's the one piece of good news here.
Yeah, and the therapeutics too.
Somehow we started on debt and we wound up on pandemic, but I think everything winds up on pandemic these days.
Everything comes back to healthcare, John. Everything comes back to healthcare ultimately, it turns out.
I'll show you the free market answer to healthcare where we get better stuff much cheaper someday, but that's not for today.
Well, as I've said, I would love to reconvene this so we could delve into more of how we should be spending money. But unfortunately, we only have an hour today, but hopefully we can all come back and do this again soon because we are up. But before we close, I first of all I want to thank our panelists, as said, who are all very busy and I've learned so much. So I'm so grateful that you all joined us. And I said, I hope we can do this again. And also I invite everyone to browse the Manhattan Institute's research and subscribe to our newsletters. If you're able, please also consider supporting the Institute at the link you see below. MI is a nonprofit organization and our work depends on support from people like you. So thank you for joining us and thank you again to our panelists.